Hey there, everyone. Happy Thursday, April 24th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you, as always, from a beautifully sunny Redmond, Washington. It's another gorgeous week here in Redmond. Knock on wood, we'll keep that going as long as possible. Maybe that means messy spring, rainy kind of season is over, and we're in kind of the sunny part of the year. Here's hoping, but for now, we'll take it. Markets also seeing plenty of sun and not a lot of rain, although there were some droplets of rain in sectors like consumer staples, growth names like IBM, and elsewhere kind of peppered around the equity universe. But generally speaking, the strength in growth stocks has propelled the S&P 500 and the NASDAQ up to another decent day. We're approaching that key trend line resistance that we've talked about, right? The key trend line on the S&P 500 connecting the major highs of 2025. We're there. Today, it almost looked like we were going to eclipse it. We didn't quite do it, but we're very much at that point. So a lot of charts to talk through. We're in the midst of and really the meat of earnings season right about now. As a result, we're going to spend a lot more time than usual looking at some of the individual stocks, some companies that reported yesterday that were big movers today. A number of names are reported before the open, a couple that are reporting after the close today. Big names we probably want to check in on and see how things played out. So with that in mind, let's get right to the market recap. Sorry, I was staring at the market carpet earlier. Here we go. Looking at the major averages again, another nice update, right? Yesterday, we had that lower close. We closed more toward the lows of the day, but today back to that strength that we saw on Monday and Tuesday's session. The S&P up 2%, so that's eclipsing yesterday's high, which is kind of an important. It's one of the reasons why I like this just two-day, preview chart, just to see how we kind of opened near the lows but closed above yesterday's session. Pretty good follow through. That brings the S&P to right around 5485, so not quite above that 5500 level, but boy, we were really close. I mean, that's 15 S&P points away from today's close. That's not much. So would not take much more to get the S&P pushing above that 5500 level. If so, we'll talk about the next upside objective when we get to the chart review portion, but I think we would have to certainly consider the likelihood of further upside before any sort of counter trend rally would be exhausted. And at what point do we declare it not a counter trend rally anymore? I'll share you that level for me in terms of what that means for me. The Dow up as well, pushing above 40,000. So that's obviously an important big round number, up about 1.25%. So not as much as the S&P, but the real strength today was in growth. Although you'll see some of the value sectors actually had really good days, but it was the strength in technology that really propelled the NASDAQ higher today, up 2.7% for the NASDAQ composite. Mid cap, small caps, all having pretty decent days though, right? Mid cap, small caps, the S&P all right around 2% for the day. So no real like market cap theme there. It wasn't like it was just the FANG stocks and nothing else. Smaller names actually had a pretty decent update as well. That might be an important data point to keep in the back of your mind. Certainly helping the breadth indicators, which have been questionable at best in terms of the long-term breadth indicators. Short-term breadth indicators on days like today, certainly getting further upside. We highlighted how the McClellan oscillator has very much rotated above zero today. It will continue to propel higher, given the strength that we saw today. VIX moving another 2 points lower. I mean, it's still way higher than I would be comfortable saying is any sort of a low volatility environment, right? If you look back at like 2024, VIX in the teens, it's sort of that standard bullish range where the market's sort of onward and ever upward kind of phase, and volatility is low. We're still pretty elevated here around 26.5. Now that's down quite a bit from 36.5 and certainly down from 50, but still in that high volatility range. We'll continue to monitor that. I think one of the most encouraging things I'm seeing is the fact that the VIX is trending in the right direction. But the directional movement doesn't change the fact that the options market is still pricing in pretty significant swings, which means days like this are going to happen. Big down days of an equal percentage kind of move are probably still going to happen as well until we're through this sort of period, however we want to talk about it. All right, looking at the bond markets, you can see bonds are actually up today. So both stocks and bonds moving to the upside. The TLT was up just over 1%. The yield curve generally moving lower. So you can see the 10-year Treasury yield finishing the day right around 4.3%. The 5-year point around 393, and the long bond yield now below 4.8% again. So we're seeing the yield curve sort of flatten a little bit, and we're seeing bond prices move higher. Dollar index slightly lower, about 0.4% lower for the UUP. That's a bullish dollar ETF that we track. Looking at the commodity space, I'm really excited, by the way, for you to check out the latest episode of our Market Misbehavior podcast. It's not quite ready because I interviewed Jeff Hughes earlier today. Really fun conversation. We talked about gold and silver, some really cool long-term charts I think you're going to want to see. Also, his downside projections for the S&P. He is not a believer on this rally phase that we're experiencing. He sees this as a pause within a longer bear phase. I'll let him share with you his downside projections and how we derive them. But it was a really good kind of thought-provoking presentation talking about valuations and how the market is still valued exceptionally high relative to historical norms. A lot of good content in there. That'll come out on the Market Misbehavior podcast hopefully very soon. And by the way, Tuesday's episode was with Rob Thummel, who's an energy portfolio manager. We talked all about energy, focused a lot on natural gas energy infrastructure. It was a really educational discussion. I kind of forced it that way because I wanted to ask him sort of foundational questions about how to think about the energy sector. And I thought it was really, really interesting. So I hope you'll check out both of those episodes. Rob Thummel out already. Jeff Hughes should be out tomorrow morning for you. At the latest. So please enjoy when it comes out. Reason why I thought of that here is because we talked about gold and silver prices. Silver is essentially flat today, but gold was up about 1.5%. So the GLD having a nice, decent update. And that's after pulling back the last couple sessions. Crude oil prices higher, copper prices higher. Generally, commodities were in good shape, except for natural gas, which drifted lower today. Looking at cryptocurrencies, kind of stalling out here. Bitcoin actually round trip down to just below 92,000. And then during the equity trading session, propelled back up, getting back up toward that 94,000 level, not quite there. But generally, I would say the price action in Bitcoin pretty constructive. I mean, it was actually a nice consolidation and then breakout phase, which I think was pretty well laid out. If you look at the chart, Ethereum prices down 1.8%. Bitcoin and Ethereum have not really been too highly correlated. If you look at their year-to-date performance, Bitcoin has remained fairly strong. Certainly relative to Ethereum, it's been a much better place, but Ethereum is starting to rotate higher. So both charts that I think are worth paying attention to for potential upside rotation. Looking at the 11 S&P sectors, you can see, again, technology having a fantastic week. The XLK up another 3.7%. We'll talk about IBM down on earnings this week, but overall, the tech sector continued to look pretty strong here off of the early April lows generally. Industrials number 2, materials number 3, both of those up over 2%. A lot of earnings in both of those sectors here today. We've got some miners. We've got FCX. We've got Nucor, NUE. I think I grabbed one of those charts. I think I grabbed Nucor to look at, but we'll take a look at some of those. Consumer staples, one of the more defensive sectors. The only one down today, down about 0.9%. Some really rough earnings in that sector in particular. You'll see on the market carpet, there's quite a bit of red in that sector today. Again, a lot of too many earnings calls for us to hit on all of them individually, but we'll highlight some of the most important ones I think you should know about. Utilities and real estate both up, but up slightly and definitely lagging behind the major indexes. So, today and really this week has been continuing that counter trend rally off of the April lows. Growth over value, offense over defense, sort of, days like this certainly exude confidence that this is just a recovery phase and we're just sort of in the early innings of it. And that's why I think we need to pay attention to key levels. That 5,500 level, very, very close. That's what we'll be watching here going into tomorrow's section. Do we finish the week above that 5,500 level? We'll see what happens. Looking at breadth, overall quite strong. And again, the trend in breadth this week has been pretty remarkably positive. You had one down day on breadth, but overall it's been pretty good. We have a 4-to-1 ratio of up stocks versus down stocks, or advancers versus decliners. NASDAQ composite, 72% positive, 25% bearish. So overall, again, the breadth has been pretty impressive. I mean, if again, As much as I think everyone loves to boil down, for me or anyone else that has a channel or has a megaphone of sorts, to try to boil it down into, is he bullish or bearish, or are they constructive or not on the markets? I mean, things are not always that straightforward. And I would tell you right now, you've got plenty of mixed evidence. I mean, if you look at the short-term breadth, it's not bad at all. It's actually quite good coming off of the April low. I think that's encouraging. You see some stocks bouncing off those lows, maybe making a higher low. I think that's all encouraging. The best thing I can do, though, is look at the weight of the evidence. And I would say there's still plenty of things that tell me this is a rally within a downward phase that haven't turned positive yet. So for me, as a trend follower, those trend following things have not really reversed yet. We'll see what happens if this short-term breadth, if this short-term momentum can turn into a long-term change, still to be determined. I will note the market trend model will update it formally tomorrow. As of this moment, the long-term model actually fluctuating between bullish and bearish as days go in and out. So we'll see what happens. It's going to come down to a Friday's close, literally come down to the wire in terms of what would happen. It would have to be a pullback tomorrow, kind of a sell-off going into the weekend to trigger that model negative. We've got, pretty good earnings here today into tomorrow. Maybe that would be enough. We'll see. We'll see what happens. Looking at the Magnificent Seven and friends, I mean, honestly, a very good day here for these leading growth names. Broadcom up over 6% today. That's your top performer. Netflix pushing to new highs, threatening the 1,100 level. This is after breaking above 1,000 this week, and we're up another 4.5% today. NVIDIA, 3.6% higher as well. Tesla having a nice bounce still. I mean, and again, this is the problem I have with like Tesla up 3.5%. Like that's good. It's a good day. Does the chart look anything but meh right now? And I would say absolutely not. Right, a day like today, 3.5% feels like, wow, Tesla's a great chart. It is not a good chart. I mean, it's at best an okay chart. And I don't think that's much of an opinion. That's literally just assessing the technical conditions. I don't know how you could use the best practices of technical analysis and call that a great chart right now. You can call it an okay chart. You can call it a let's see what happens kind of chart. That I have no problem with, but it's consolidating, right? At best, it's range bound still. So again, this is it's very tempting to look at days like this and think, wow, Microsoft's an obvious winner. It is not an obvious winner just yet. A lot of these charts are still bouncing within downward phases or consolidation phase, just more to prove. Apple's your worst performer, but is still up almost 2% today. So it really was the leading growth names getting it done. If you look at the percent returns that are represented from these mega cap stocks, that's enough to propel our major benchmarks higher. So if all other 490 S&P members were down a little bit, the benchmarks would probably still be slightly higher. It's probably an exaggeration, but you get my point. These have an outsized impact on the benchmarks, and they were up pretty good today. All right, that is it for the market recap. Let's get to the heat map. As a reminder, I can see questions. I already see a number of really interesting questions coming in with from YouTube, LinkedIn, Facebook, and X. I appreciate you guys tuning in live on any of those platforms. Those that are doing so, please drop questions as they come up as we're going through the charts and going through some market data today. I'll try to get to as many questions as I can at the end. And then anything we don't get to, we are planning an all mailbag episode tomorrow. And I would love to answer one of your questions then. So get your questions in now. Much, much appreciated. And if you're watching the replay on our YouTube channel, just drop a comment below the video with any questions that you have. We're always looking for good questions to feature on our mailbag shows. All right, here is the heat map. And you can see again, I mean, what strikes me with most days this week is the bright green in the biggest boxes, right? So in the upper left, we have the big technology names. In the middle, we have the big consumer discretionary names. In the bottom middle, we have the big communications names. All of those larger names were up pretty good today. And Apple only up 1.8% was like the big laggard. I mean, look at the top 10 technology names. They had incredibly strong days. And you have random things like Tyler Technologies, IBM, drifting lower. But the average stock was actually quite strong. And technology, by far the top performing sector today. Also struck by the strength in industrials, right? Airlines like Southwest having a pretty good update today. Now, again, these are coming off of pretty beaten down levels. These are not necessarily great charts over the last couple months, but certainly bouncing off of the lows. And elsewhere, some of the names like Raytheon, some of the defense names which have been pulling back here NOK is actually still down another 2% today, it looks like, but Raytheon is sort of holding its ground a little bit. So industrials generally kind of an interesting day. And it was interesting after technology, it wasn't the other FANG sectors, it was industrials and then materials. And there's a lot of earnings in those sectors this week. In materials, you have Newmont Mining, one of the gold stocks, threatening to make a new high for the year. A bunch of other Steel Dynamics and other steel companies. Nucor, I think I grabbed for a little later. These are stocks starting to break to new swing highs potentially. Mosaic making a new 3-month high today. So some interesting upside rotations in more value-oriented sectors, more cyclical sectors. But I think that's a very encouraging sign. I mean, if you're bullish, I'd feel very good about seeing industrials and materials and other things starting to do a little bit better. Also, banks. I mean, the chart of Goldman Sachs, I would say still making lower highs and lower lows, but this is a good thing that we're bouncing off of the lows and making some progress. And I think the danger with this market is that names like Goldman Sachs bouncing off of the lows are just making a lower high. We just don't know it yet. And again, the most bullish thing these things can do is go up, right? And so with Goldman Sachs, with Morgan Stanley, with Bank of America, most important thing we can do is make a clear higher low and then just continue a new uptrend phase. So it looks like it's not going down anymore. And I'm struggling to differentiate between those two just yet, right? Sort of in the middle of that rotation. All right, let's get to the chart review. Before we do so, do want to highlight, we've done some major league upgrading on our website. Really had fun upgrading. Thanks to the good folks at Squarespace for having a cool website that I'm able to tinker with. I've been long overdue to improve it and totally overhauled our recommended reading list. So check it out. If you're looking for some things to upgrade, I tell you what, I've learned more during bear market phases than bull market phases, and it's not even close. Use this bear market as an opportunity to learn a little bit more. You can go to my website at marketmisbehavior.com. Just click on reading list in the upper right corner or scan the QR code. You can get to it. All of those are Amazon links. Those are affiliate links. So it helps me make market misbehavior awesome, but hopefully gives you some good ideas of reading. If you're looking for some spring break reading to upgrade your analysis, take a look. All right, let's look at the charts here. And let's see how things have played out. So we've talked about this trend line, right? This bright purple trend line. We formed this trend line from the February peak and connecting that to the March peak. And as you can see, that actually is connecting very well with where we almost reached today. So here's, Monday, Tuesday, Wednesday, Thursday, really coming off of the low. Monday's low was around 5,100. From there, we've bounced beautifully for the remainder of the week to get up to this point. Yesterday really was, I would argue, a shooting star candle. Today, ignoring that completely. And with the fact that we broke above yesterday's high, that sort of negates that shooting star. That's no longer a valid candle pattern. At least that's how I was taught it, right? It's a valid pattern until you break the range of that pattern. So, so today's higher close is a bullish follow through. The real question is, do we have enough momentum left after this rally from 48.50 to 54.50? Do you have enough momentum left to get further? And this is where an initial rally off of the lows can happen for a lot of reasons. A sustained advance driven by true accumulation takes some effort. And I would think right now we're sort of at that decision point as to whether or not we have enough to get through there. So I think the bull case from here, obviously we go above 5,500, we go above this trend line. If so, the 200-day moving average, the next level. Not to take away from my interview with Jeff Hughes, which will be out very soon, but he and I are in agreement that 200-day moving average is kind of the differentiator. As long as we remain below it, I feel comfortable still thinking of this as a corrective pattern. But we get above the 200-day, I don't think you can pretend that that's true anymore. And so look for that 5750 level. So think of it as an if-then statement. If we get above 5,500, I think that opens the door to 5750, and then we reassess and see what happens. Worth noting, the RSI is still pretty weak. So even with the rally that we've had off of the lows, the momentum is still not super strong. If you're wondering why it's not stronger given the rally, it has to do with sort of the day-to-day movements. The way RSI is calculated, it looks at the strength of up days and the strength of down days. And because we've had these big, heavy down days, it's kind of skewing the indicator more negative. It tells you the momentum is not as strong as you would expect from the fact that we've gained 600 points in the S&P over about a 2-week period. And so with all the gaps, with all the big moves to the downside, even though the trend has been up over the last couple of weeks, that's what's keeping the momentum relatively low. And that's by design, right? That's meant to, really look at the path, right? That the path matters from point A to point B. And if it's a direct move of accumulation, the RSI is very positive. If it's a move with a lot of distribution, the RSI remains more negative. And that's one of the things, along with like lighter volume, that probably makes me more skeptical than I would be otherwise. Chaikin money flow still firmly below zero here, even with today's bounce. Now, like a bounce like today causes an uptick in the Chaikin money flow, but it's still technically in the distribution range as below zero. So again, off of the lows, like you're seeing this nice rally, but the volume was much stronger on the sell-off. We're getting less volume on the upswing, and just there's been enough distribution during this period to keep the Chaikin money flow negative. So again, indicators that could be much more positive here are not yet. And so again, I could be, we at some point we sort of get a bullish confirmation as we break out. That's a possibility. It's certainly a possibility, and one I'm very much open to. I just haven't seen the validation that I would need to see from volume and momentum to really believe that this has further upside potential, meaningful upside, as we would say. Weekly survey data all came out here today, so I'll update you on the AAII survey as well as the name exposure index, both with their latest readings. AAII survey, I guess I would say a little more neutral. So you had a couple less bulls, you had a couple less bears. So most likely that means some bulls were more neutral and some bears were more neutral, I guess, is how I would probably generally think about that. If you look at the AAII survey, just to zoom in a little bit here, hold on, there we go. So if you look at this survey, right, this is a weekly survey of individual investors. The green bars tell you the percent that are bullish. The red bar is the percent that are bearish. The bottom panel is the net difference between bulls minus bears. And I kind of consider all three of these data points as I'm evaluating the sentiment. I mean, if you look off of the February market peak, which is kind of right here, the survey was actually most bullish in mid-January. At the February peak, it was a little bit lower. And then we kind of plunged down, and at the lowest point was around 20% bears and about 20% bulls and 60% bears. So about a 2-to-1, 3-to-1 ratio, that is, of bears to bulls at that particular time. Now, from that point on, it just hasn't changed a ton. And again, that's with the big sell-off, that's with the big rally, all the noise, all the elevated volatility. There's kind of a group of bullish investors and there's a group of bearish investors. Neither have been particularly convinced otherwise, is how I would read this chart. And the spread between the two is almost identical to what it was. I mean, a little less, but still pretty exaggerated to the downside. So it's sort of like, if you're looking for a bunch of optimism coming in, I'm not seeing that from the survey just yet. I'm seeing skepticism at this rally, and a lot of people that are all bared up and defensively positioned remain there and are just waiting for the next shoe to drop. That's certainly how I feel myself when I'm evaluating the macro conditions. I'm just waiting for the next headline that's going to tell me things are going to go lower. That's probably just a horrible attitude, maybe. And I'll be the first one to admit it and to change it when we start to break out further. But this is pretty significantly negative. And the reality with the AAII survey, if you go back in time, is that in bear market phases, these can actually remain much more negative. And so I think that's one of the challenges here. Name exposure index. This is the National Association of Active Investment Managers. I interviewed Ryan Redfern, who's the president of Name, a couple months ago. You can find that interview, my podcast interview, on my YouTube channel. And if you look, he and I talked about just what this survey really represents. And it's a group of money managers that just are asked their exposure to the equity markets, really their allocation. And so this implies an average 41% allocation to equities. Now, if you think about what the average investor's allocation to equities, it's usually up here in like the 70 to 80% range on the survey. So 41% is lower than average. As a matter of fact, it's gone down for about 2 months straight, coming off of the February peak, where it was around 92%. Here we are 2 months later, we're about 41%. So about 40%, 50% decline in equity exposure over that period. So the money managers in the survey, not accumulating at this point, are actually continuing to lighten up, and that's a concerning development as far as I'm concerned. If we're really optimistic, you'd want to see, and I think what could cause a sustained rally would be flows, which is this allocation starts to turn higher and higher. I'm seeing skepticism in those numbers. The bottom panel, by the way, is the Ridex flows. This is looking at the Ridex fund family and a bunch of different, big fund family, lots of different types of funds, offensive funds, defensive, more cash money market kind of funds. And this series actually looks at rotation from the offense to the defense. So if the bars are getting bigger, that's investors rotating to the more defensive funds in the family. If the numbers are getting, closer to the zero line, that means investors are getting more offensive. So, investors in the Ridex funds super bowled up in the fourth quarter of last year, beginning of this year as well. But in the last 2 months since the February peak have gotten pretty defensive. What concerns me here, not anywhere near as defensive as we've seen at previous major lows. So while the low earlier in April certainly felt like a big one and could end up being proven to be the low, that would be very different than most of the history, recent history at least, of the Ridex flows, which have seen investors get way more defensive before a sustained low is actually in place. So this is what I'm talking about. I mean, I think there are plenty of indicators that suggest this is a nice bounce with upside potential. I'm seeing other indicators that are still very much in the, there's still, we're not in the clear yet. And so it's mixed results is the best I would describe the evidence, I think, on the macro side. All right, let's look then at the micro side. From macro to micro, let's look at a bunch of individual stocks. We'll go kind of rapid fire because there are a bunch of charts. I probably picked way too many to go through, but we'll see what we can get to. Netflix making a new all-time high today. I'll say it again. Netflix is making a new all-time high today. And again, this is one of those reminders that, as I say at the end of any episode, it's always a good time to own good charts. It doesn't really matter to me what I think about the broader macro environment. This is more of a Peter Lynch kind of mentality. It doesn't really matter what the S&P or the NASDAQ are doing. If Netflix is going up and if Netflix's business looks bullish, I should own Netflix, right? And it should be an assessment about this story and the upside potential of this company's ability to generate earnings. And it's not to say that they aren't subject to a lot of the same challenges that other businesses are, because it is. But again, that'll probably be reflected on the chart when things change. For now, it's making new all-time highs. We've talked about how this remains the best chart in the Mag 7. I would say that's still the case. Still working today. Apple, continuing to rally, similar to the trend line that we're highlighting on the S&P 500. Apple's kind of right there, right? It's not quite breaking above the trend line from the February and March peaks, but it's very, very, very close to doing that. And I think if we finish the week above that line, it's going to be hard to be too bearish on Apple for now. I mean, the bad news for Apple is you have overhead resistance right around 225. That's the swing high from late March. That's also the 200-day moving average. So is that your upside before you start to think about maybe another down leg? I mean, maybe. But again, breaking above the trend line is not a bad thing. And that's, again, still not quite there. Tesla, as I mentioned, it's not a bad chart. It's not going down. There are charts that are going down still, and those are bad charts. This isn't a bad chart. Support around 220 continues to hold through March and through April. And rallies like we've seen this week are encouraging, but it's not sort of breaking out. And I think that's the challenge with the chart of Tesla. I think Tesla over 290, breaking above the 200-day is a pretty good chart. I think that would arguably be a very good chart, but it's not there yet. And I think for me, I'm happy patiently waiting for that breakout to occur. Yesterday on the webcast, by the way, if you checked it out, we focused a bit on the chart of Tesla, talked about some different ways you could approach that chart. So I hope you enjoyed that discussion if you tuned in. Broadcom starting to break out quite a bit here, clearing the April peaks, clearing the 200-day moving average today. It's all about tomorrow. It's all about that follow through. We've highlighted a number of times over time about the importance of what we call follow through, right? Once you have a close through a key level, it's all about that next day. So do you see additional validation? This point, which is right around 183, we'll call it, is a pivot point that's actually been in play on the chart of Broadcom for the last 12 months, going back to June of 2024. We're talking about this level. We eventually gapped above there in December of last year. We then had a gap down, which made what's called an island reversal, which ended up leading to this deterioration down to around 140. Now we're back to resistance a number of times at the 200-day and at that pivot point. Do we get above there? We've had a couple failed attempts to close above there in April. Is this the final time when we do it? And if charts like Broadcom are breaking out, that's pretty encouraging. IBM was an earnings name yesterday. Did not go particularly well. You saw on the heat map, IBM was one of the few S&P technology names down, but it was down pretty good today, down about 6.6%. The 200-day moving average still holding. And if you look back in summer of 2024, if you look back in fall of 2023, holding the 200-day moving average was a pretty important threshold. For now, it's holding again. We tested it earlier in the month of April. Now we're heading back to that point. I think this chart above the 200-day is not a bad chart. I think the chart below the 200-day moving average all of a sudden becomes a chart I probably want to be avoiding here, because what it's telling you is it's not holding that key long-term barometer. So I think for IBM, we're very close to where we need to start to reassess the bullish phase there. ServiceNow was another earnings name yesterday, popping up pretty good today. You can see the 200-day moving average is around 925. We opened the day at 900. We closed above that level at 15. That means an upside of 15 plus percent just today. So again, the question is follow through after this gap higher. That's super encouraging. I'd want to see if we can hold the 200-day tomorrow. And if so, I think that's a pretty encouraging chart in the technology sector. Boeing had earnings yesterday, gapped higher, traded a little lower today, actually closing above yesterday's range. That's pretty encouraging here. Boeing is one of those names with tariffs. You have to just think about the potential impact. It's been a gappy name, and again, not a great chart. I mean, generally, if you look at the longer term, it's still sort of in this languishing in this 130 to 180 range, but we're getting back toward the upper end. And I think getting above those highs around 187 would be a pretty encouraging follow through on Boeing. Ooh, man, Pepsi not looking good. Now Pepsi has not been a great chart, and when I talk about charts that are not good charts, this is the kind of thing that I have in mind, right? Bad charts are charts that fail to hold support, right? We looked at charts like Intel, which we'll look at in a minute. Finding support, holding support a number of times. That's why I think Pepsi holding 140 is okay, right? I mean, it's like it's not going down, but today's breakdown on an earnings miss is not encouraging. And a lot of consumer staple stocks had this sort of configuration today with some earnings pressure. So down about 5% today. I think that basically confirms the bearish phase. We're below two downward sloping moving averages. This is the type of chart I avoid if it's not able to hold support. Procter & Gamble reported earnings before the open today. For now, holding support. You can see the number of times we've kind of tagged this 157-ish level going back to the summer of last year. This has been where the stock has bottomed out before. We also have a lot of overhead resistance kind of in the mid 170s if we would rally higher, but I'm concerned about this downside gap on earnings. What you're really looking for going into this week is you have a nice earnings report, which propels us back to the upper end of the range. We're getting the opposite. So I'd probably be hesitant to take a nibble at a chart like that until we get some sort of stable low. All right, let's talk about some charts, companies reporting earnings today. And we'll start with Alphabet. We can see the chart of Alphabet, going into today's report, making a bit of a higher tactical low here around 146, rotating higher. Again, I still think of a chart like this below two downward sloping moving averages as guilty until proven innocent, but very close to starting to follow through to the point where you'd start to think, all right, maybe this is improving. The momentum has not been great. I think that's been one of the challenges for sure. Let's see what's happened here after hours. Ooh, moved around a bit here, but currently up about 4+ percent, 4.3%, we'll call it. So it's up to around 166 in the after hours. So after hours trading, we're kind of getting up to that point. If that's what happens going into tomorrow, that would be, that's going to be a pretty strong finish to the week for Alphabet. It's able to follow through there. That means pretty much from Monday's low, you just have this nice upswing. Again, still want to see it clear moving average resistance. And I think the real level I'd be watching is sort of that 170, 172, which would be the March swing high and that 200-day moving average. But nice breakout here would be really encouraging. What a nice finish to the week for Alphabet. Intel's another one. Now, Intel is one of those stocks that's been testing support, like with P&G, right? Testing support, but then breaking. The question for Intel is, can it hold support? We've bounced from around 18 up to around 2150 going into in today's report. Let's see what happens over here in the after hours. Not so good, right? So down to around 2050, we'll call it. So that's down about 4.5% in the after hours trading. So currently trading, I mean, not too bad, right? We're trading kind of down around yesterday's close. So giving back today's gains after the earnings report. We'll see what happens tomorrow, but this one looks like maybe not as bullish of a follow through. Freeport McMoran was up today. Nucor also. Nucor's reporting earnings after the close today. NUE. This is the materials sector. Basically flat in the after hours trading, but this is a stock that's actually gapping higher on Wednesday session today, pushing a bit higher as well. So materials coming again. This is still not a great chart in my opinion, right? We're below moving averages. They're all sloping downwards. The momentum is negative, but continuing to push higher, stronger momentum, RSI pushing above 60. All of those things would be encouraging. Finish on a positive note. This isn't an earnings name. Actually, it was an earnings name yesterday. But what I love about the chart of GEV, this is one of the GE spinoffs from last spring, breaking above resistance. And when I talk about charts that are kind of neutral and what it takes to be more positive, I just wanted to highlight, like, this is the kind of thing I'm looking for. If you look at what's happened to GEV over the last couple months, right? We made a new all-time high around 449, we'll call it, in mid-January. We gapped down what's called a breakaway gap, which is an impulse move in the new direction. We trade lower. We test the 200-day in March. We closed below the 200-day for 1 day in early April, and then closed back above it. And those bounces there around 265 are right at a 61.8% retracement back to the August low, which is sort of the first major low after that, that spinoff date. So you have that low, you have the high from January. 38.2% was where that initial gap traded down to. 61.8% ended up being the low. We've actually traded up to the 38.2% level a couple times this week, finally breaking back above the 38.2% retracement, back above the 50-day. That's after bouncing off the 200-day. I like that chart. I like that breakout of this consolidation pattern. This is a chart showing accumulation on stronger momentum, improving relative strength. That's what I'm sort of looking for on some of these names that are having rallies, but they're just not following through and breaking above resistance like we're seeing with GEV. That's a good model of the type of chart that tends to impress me. All right, some really interesting questions as we go through. Let's take a question or two here. Richard, thanks for watching on YouTube. You said, or you asked, on the SP chart, there's a gap. Tomorrow is the last day of the week. Could this result in a down day and a down gap filled? Let's take a look again at the daily S&P chart. So what you were saying here, there's a gap here. I think you mean that. Well, so there's so many gaps on the S&P chart. I'm not entirely sure which one you're talking about. Unfortunately, there's a problem. But there's gaps all over the place. There's this gap maybe that you're thinking about, which we're sort of right at the level of. There are a bunch of other gaps here that we're thinking about as well. So generally, I think of gaps as support and resistance ranges. I don't have them notated on this chart as much, only because I found I can make this chart really busy very quickly, and so I try to avoid putting too much on the daily S&P chart. Although, having this sort of gap here, I think that's sort of, if you look, this was sort of that first gap after the tariffs were announced. This was like tariff day. And then we opened lower, and then the big gap, 2 days in a row of gapping lower. So this is sort of that initial gap. That's why 5,500 is that big, heavy pink line here. So I don't have the whole gap notated, but that's kind of why I thought this would be a significant level. It's a Fibonacci level. It's also sort of the initial gap. That was our open, right? So once we are faced with tariffs, the initial, valuation of the S&P was right at 5,500, which is why I think reclaiming that level could be pretty encouraging. Does that mean we move down from here? That's why I'm thinking of it as a support and resistance, as like a resistance range. I think that's pretty important to watch. We'll see what happens. Again, I think tomorrow is going to be a pretty important way to finish the week, particularly with the lighter volume that we've seen. Right? I mean, the volume has not been as encouraging as you might have hoped. Let's see. Jeremy, I think you're talking about the AAII survey. So let's bring that chart up. And then you asked, do you think that the 20% that's always bulls or always bears are the same people and they are just contrarians? It's a really good question. I mean, I would love to, that would be an awesome book to write, would be like deep discussions, interviews with a series of people that have voted in the AAII survey for like decades and learn what motivates their decision. Are they talk to people who are just always bullish and why and bear? I think that'd be fascinating. I'd read that book if someone wrote it. I don't know if I have the gumption to do so, but it's on a long list of ideas I have. It's funny, and I talked with a couple of my podcast guests recently when we've talked about sentiment. It's like this is the reality of the series. The bulls, I mean, almost never. I don't remember a time when it's gone much below 20%. That's kind of the floor. And the same with bears. There's rarely, I mean, any less than 20%, which basically implies that a group of people are always bullish and always bearish and just plug their nose and vote every week. Now, that may not be true. I mean, that's anecdotally what makes sense to me. It could be there's a lot more fluidity and people literally change that just where it nets out. I think probably what's more likely is that you think of it as sort of like with political voting. I mean, we talk about something that's become fairly polarized these days. So I don't know if I want to go there, but you think there's that group of people that would always vote Republican and a group that probably always vote Democrat. And then there's the moderates in the middle, which are like the swing votes, right? And there are states that are always blue or always red. And then there are these swing states. And so it's not like others aren't important. It's just like there's probably not going to be a lot of movement there. And so it's really the swings and how they go. And I think that's probably what's happening here. That's pretty common with any sort of like, any sort of survey data is you kind of have the middle, and that middle of the curve is what's really moving things and tilting from one side to the other. The people that would actively change their perspective based on the change in the evidence. And that arguably is what makes the survey so valuable. Let's see. I had a couple questions as we talked about commodities earlier. And one, a person, thanks for watching. There's a switch on flows from gold to silver. I won't comment much on that right now, but I will tell you, make sure you watch the interview with Jeff Hughes, because we talked particularly about gold. We talked particularly about the rotation to silver. In his opinion, the gold trade is still good, but the big gains have been in gold. Silver's been lagging, and he sort of saw that as an opportunity for silver to be the next big gainer, as one of his top ideas. So I'd encourage you to listen to that. If that's something you're thinking of, I think his comments might really help you understand maybe another perspective, validating what you might have seen. All right, folks, that'll do it for today. I want to thank you guys so much for watching the show here. Those that are watching live. And if you're watching the replay on a YouTube channel, I appreciate you as well. As a reminder, we'll do an all mailbag episode tomorrow. The last couple ones have just been fantastic. I can't thank you guys enough for asking some thoughtful questions. Gives me some really good content, really good questions to consider and spend more time answering. And I look forward to doing that for tomorrow's show. In the meantime, have a great evening. And remember, it's always a good time to have to own good charts. I butchered my own tagline. Have a good night, folks. Bye now.